On today's Run the Numbers, we explore how to sell over $4 billion in sandwiches and own almost none of the stores. This is the Jersey Mike's IPO S1 breakdown you didn't know you were hungry for. I'm very hungry. I'm staying up here to do this before dinner. All right, let's get to it. Is this thing on?
Yesterday's price is not today's price.
All right, what's the origin story here? Peter Cancro was 17 when he borrowed money from his high school football coach and bought the local sub shop he worked at. The shop was called Mike's. Peter's name is not Mike, but Peter is very rich because 50 years later, he sold most of the company to Blackstone in a deal that valued it at $8 billion. And if he's adopting either children or CFOs, I am very available because on the way out, he cut his stepson a $50 million check, his longtime CFO another $40 million check, and bought back his private jet for a cool $41 million. And then he threw the deuces. Jersey Mike's is in many ways the American dream, sponsored by private equity, and now available in S1 format. I have eaten an unreasonable amount of Jersey Mike's over the years, so I live next to one, which was adjacent to a car wash in Florida. And as someone who worked from home and had very little social interaction, I'd make it a trip on Friday afternoons to get out of the house. I'd get the truck washed, which was my version of retail therapy. My wife's version is much more expensive and does not include oregano or salted meats. And I would sit by myself like Steven Glansberg in Mike's, like a complete psychopath.
What, so I gotta sit here and eat dessert alone like I'm fucking Steven Glansberg?
When a company I have destroyed t-shirts using their product files to go public at a number people keep whispering is north of $12 billion, I go nuts. I eat it all up. I go through all 291 pages so you do not have to. The TLDR here, if you don't get any further, Jersey Mike's does not sell you a sandwich. More than 630 franchise owners sell you the sandwich. Jersey Mike's sells them the right to do it and clips 6.5% and a little bit more, which we'll get to, off the top of every register in America. The filing doesn't hide the ball. They say Jersey Mike's operates a proven, highly franchised, asset-light business model that generates stable, diversified, and high-margin cash flows. If you peel off the sandwich wrapper here, it's really a royalty business that is just firing on all cylinders, right? It's not really a restaurant business per se. And the only thing I like more than metrics are large Italian subs. So let's get into it. What are the key metrics? A quick rundown before we get into the weird stuff. These are the somewhat clean numbers ahead of what Blackstone did to the balance sheet. Okay, so system-wide sales, $4.2 billion in 2025. This was up 13% year on year and up 12% the year before. This is what you would call the big number flowing through the entire system. It's not the company's actual revenue, right? Every dollar that Jersey Mike's makes is a slice of this bigger number. So that's the entire amount of sales going through all their franchisees. Their annual revenue, what they get to keep as a company, is $724 million. That was up 11% year on year. Royalties and other fees were $483 million of this. And then the marketing fund that franchisees pay into was $203 million. And that roughly actually offset their own ad OpEx. And their handful of company-owned stores, they do have a few, raked in $38 million. So the royalty line is actually where all the EBITDA lives. Their net income, kind of paltry, $55 million. This is very thin against $724 million of revenue, and it's a leverage buyout artifact. It's not really their actual business's reflection of like what the engine is. The Blackstone section that we'll go through, we'll walk it back to what the actual operating company can generate, which is an adjusted EBITDA of $339 million last year, which is an astounding 47% margin. And these are clearly franchisor royalty economics, not restaurant economics, right? Most restaurants operate in the low single digits of margin. What is their average unit volume, or AUV? Think of this as the per shop revenue. So if you own a Jersey Mike's location, on average, it pulls in $1.4 million in revenue. And that's actually 3x the average of US Subway locations, which are notoriously low. And also the worst thing about eating Subway is smelling like Subway the rest of the day. Same store sales growth, 3.2% year-over-year growth. This one might be worth circling because it ran hot at about 8.4% in 2023. Then it dropped to just 2% in 2024. It wiggled its way back to 3.2% in 2025. And it's pacing at 2.5% in the first half of 2026. A good chunk of the strong years was actually menu price increases rather than traffic. Damn inflation. Can't get a $5 footlong anymore. Net store growth. 8.5%. So this is down from 12% the prior 2 years. The filing pins this on a founder-directed development pause in 2024, i.e. the year that he was looking to sell the company. Think about this as after all the stores that shut down, and then you add in all the ones that opened, what was the net growth? It was 8.5% year on year. What's their CapEx? It's really small. You got to squint to see it. It's only 11 million against 339 million of EBITDA. Franchisees fund the builds. So 97% of adjusted EBITDA actually converts to cash. Nice. And they have 12.5 million loyalty members. 42% of their sales are digital, and you can peep the sales mix right here. So about half is through the lunch crowd, and then you split up the other half between what they call the snack crowd. Yeah, that's between 2 and 4. And the people who are getting Jersey Mike's for dinner, which is after 5. They also go through the menu mix, majority cold subs, then you can get into the hot grinders, and then they go through what is purchased digitally versus in person. The majority is still in person today. So that's an opportunity if you wanted to put more units through this store without having to increase your overhead. So what are you actually buying? You're not buying a sandwich company, I'll tell you that. You're buying the company that licenses the right to run a sandwich company and bills for that right in 3 distinct ways, which we're going to go over here. So a franchise owner signs an area development agreement, which locks up a stretch of the map that nobody else can build in, right? That's your territory. And they pay $10,000 for the agreement plus $20,000 every time they open a store inside of it. That is revenue stream number 1. So that's like claim your fiefdom, $10,000 to say I have like this zip code or these streets in this area. And then each store within it, I give you another 20 grand on top of that original 10 grand. From there, they clip 6.5% of everything that the store rings up. And that flows back to the corporate headquarters as a royalty. So think about it like you buy $10 worth of a sandwich and chips and a soda, 6.5% of that will go back to HQ. So it's a simple rip off the top, right? And then they earn another 5% in the form of that national ad fund. So think of this as the marketing commitment the individual stores must pay back to HQ for services rendered, because it ain't cheap to have Danny DeVito in your commercials. So net, the real royalty rate is closer to 11.5%. plus some extra fixed fees. On the cost front, the franchisee is the one who has to front the build out, which on average is $515,000 to put a location up. And they sign the 15-year lease that ends up going along with that. They staff the line. They absorb it personally when the price of roast beef decides to move on them. The headquarters does not. The margins that fall out of this look faintly illegal for a food service because property and equipment on an $8.2 billion balance sheet comes in at just that $13 million that I said before. So where's the meat? Shit, that's Arby's. The company that hangs its name over the 3,300 sandwich shops owns about 1 gas station's worth of actual physical stuff, which is astounding because the physical stuff is somebody else's problem by design. It's more of a licensing play than a restaurant play. So 2 P&Ls, 1 sandwich. There are 2 completely different income statements worth talking about here. And both of them, they're tasty. They're good. They're doing good. So let's start with the operators. A single store does about 1.4 million in AUV, which is average unit volume, and the annual sales at one location rings up at the register. So after food, labor, occupancy, and the royalty and ad fund, it pays back to corporate. It holds a store level EBITDA margin of around 16%. So after you pay for your OpEx as well as whatever you owe Jersey Mike's HQ, you have about 16% left over. And it costs roughly $515,000 to build. Important to note, like I said, that the franchisee pays for that, not Jersey Mike's. If we run the franchise's return, they make 16% of 1.4 million, which comes out to about $224,000 a year. So approaching a $250,000 on that 515 grand that they spent to open the doors. And so this is what the pros call a cash on cash return. And it's north of 40%, the 224 over the 515. It means for every dollar the franchisee puts in, they get more than 40 cents back every year in profits. And that's why stacking multiple locations is so attractive to operators once they've got the playbook down, right? You see that, you're like, oh, I get how to do this. The unit level economics are pretty sweet. I'm going to own a bunch of these, right? I'm not just going to stop at one. Long term, they want to get the AUV to over 2 million, to go from 1.4 to 2. They want to get the store level margin up from 16 to 17 or 18. And they think the cash on cash return can be 60% if you stretch it out long enough. Is it wishful thinking? I don't know. Well, more than 330 owners run a single store, but the operators at the top of the system run an average of 60 apiece. And the biggest one out there runs 91. I want to meet that guy. I want to shake his hand. Jersey Mike says north of 90% of its development pipeline is coming from existing franchisees, which is a great flywheel because, said another way, the people who are most successful continue to line up to build out more locations, which end up being better locations because they have the precedent to lean on.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
Here's a growth tax that nobody talks about. Every new pricing model you ship creates a nightmare for your finance team. Usage-based pricing, now you're tracking usage against commitments. Product bundles, now you're untangling what to recognize and when for every line item. Mid-cycle upgrades, good luck manually reallocating revenue. The pricing strategies that drive growth are the same ones that break your finance process. RightRev turns that irony into a competitive advantage. Your product team can ship new pricing without asking finance for permission, and your sales team can close deals without worrying about downstream chaos. But I've seen too many companies where sales are celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. It's actually me. So here's a good place to start. RightRev built a free tool at calculator.rightrev.com. It scores your RevRec process, shows what's exposing you to risk, and tells you exactly where to focus before it bites you in the rear. Probably explains why your last close took so long. Check it out at calculator.rightrev.com. All right, without the Boston accent, calculator.rightrev.com. Hey, founders and finance folks, you know how early on everything is fast and scrappy, and then suddenly equity gets messy? Spreadsheets break, grant docs pile up, lawyers are sending new forms and collecting fees. It all shows up right about when you're already swamped. Well, if managing your cap table feels like one more frustrating thing on a very long to-do list, you need to know about Pulley. Pulley makes equity management simple and stress-free. You can issue options, model dilution, complete 409As, and more, all in one place with support from real experts when you need it. So if you're raising, hiring, or scaling, Pulley keeps your cap table clean so you can stay focused on building, not wrangling spreadsheets. Learn more, request a demo at pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations. Woo! Everything a scaling company needs. They've got 5.0 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me. Now the corporate P&L. This is the one you're actually buying a share of if you buy stock, right? So move over 16% because Daddy HQ is pulling down a 47% adjusted EBITDA margin. So how is that possible on cold cuts? Well, corporate skipped the lease, it skipped the labor, the roast beef, and the build out, and it took its 11.5% that we talked about off the top. Both sides are making money though. Off the same register, they do have wildly different cost structures, but they're still pumped about it, right? Which is the trick to successful franchising. Nobody feels like they're being robbed here. Let's go over the Blackstone math. And by the way, this TAM chart that they put in, I know there's no y-axis. There are no axes, but this is an area chart crime of mass proportion. Someone has to call the police. The most misleading number in this whole filing is the $55 million of net income. And it's misleading for a super boring reason. It's because Blackstone financed the holy hell out of this, and it purposefully creates a whack of interest payments and non-cash expenses. So the first thing that I do with a sponsor-owned S1 is hunt down the D&A line, depreciation, amortization, because purchase accounting always leaves a mark, in this case, a crater. The accountants, artists, they revalued what Blackstone bought and wrote it onto the books at fair value, which is how a $5.7 billion trade name lands on an $8.2 billion balance sheet that holds just $13 million in physical assets. The trade name gets amortized, and so does the franchise agreement intangible sitting next to it. And so together, they pushed D&A to $96 million in the first year under Blackstone. So they created this $96 million charge, up from about $10 million the year before. So keep in mind that none of it is cash, but it's all very real on the income statement. The debt is the other half of the equation. Blackstone dropped $2.1 billion in long-term liabilities onto the company through what's called a whole business securitization. What they did was they pledged the brand, the trademarks, the franchise agreements, and the royalty streams into a vehicle and they sold notes against them at rates between 2.5% and 5.6%. That's actually pretty good. That registers at $90 million of net interest in year one, and the Financial Times counted roughly $500 million of dividends were paid out of that debt before the S1 ever went public, which tells you what that borrowing was for. Here's a full walk under Blackstone. So you start at net income of $59 million, but then you add back the net interest of $90. You add back D&A, mostly the new trade name and franchise book, another $96 million. So their plain old EBITDA is around $247 million. Then you add back area director buyouts, which we're going to get to in a second. That's $52 million. Stock-based comp of $8 million, IPO cost of $7 million, corporate transition of $13 million, you get to an adjusted EBITDA of $327 million. When you add the interest and the amortization alone, you've bridged almost the entire gap. That's how you get to the $327 million, or $186 million of interest and non-cash amortization. These chunks are derived from the buyout structure and not actually indicative of how Jersey Mike's makes these subs. Net, if you strip the deal financing off the top and the store level business is 47% margins, the $55 million of net income is just what's left after the LBO eats first. All right, so let's talk about the 2% their CEO is clawing back. This is pretty fascinating. So perhaps the smartest move in this filing is the one that makes the current year look worse. So bear with me here. For most of its life, Jersey Mike's did not sell franchises through corporate. It sold them through area directors or independent operators who bought the development rights to region and then recruited and supported the franchisees inside it, collecting roughly 2% of gross sales on every store in their territory in return, forever. It's how Cancro grew the system without building a corporate franchising arm, and it meant a slice of the royalty stream was peeled off to middlemen before it ever reached headquarters. It did serve its purpose in getting to scale, but now the CEO is buying that annuity stream back. The company has been paying each area director a lump sum to tear up the contract. Then they pull the function in-house and they turn a permanent 2% haircut into a one-time cash cost. Pretty smart. That shows up as the $52 million labeled area director buybacks that's sitting in that adjusted EBITDA, with more coming as they work through the rest of the territories. So just know that non-recurring is kind of recurring, since the buyouts are going to keep landing in the add-backs for years while they consolidate the model. Some potential red flags. It's an Up-C structure. What the hell does that mean? It means you and Blackstone do not own the same thing. So Jersey Mike's is going public through a structure called an umbrella partnership, C Corp. Here's what that means for you in practice. When you buy the stock, you're buying Class A shares in a holding company that sits on top. That holding company's only real asset is a stake in the business underneath it, where Blackstone and the insiders hold their ownership directly. So you own a piece of the parent, they own a piece of the actual sandwich operation. The two aren't really the same piece, because Blackstone gets the tax perks of holding the business at the lower level and gets convert into your shares on its own schedule, which means you never quite know when a wave of insider stock is about to land on top of you. And generally speaking, when a company hands the public the top 4 shares, it keeps the operating company for the sponsor. That's a structure built for the seller's benefit, not yours. And they also have this chart, which you would need approximately 20 years of tax experience and a degree in Egyptian calligraphy to make heads or tails of. Number 2, the company owes its old owners a check for its own tax savings. What? This is called a tax receivable agreement. And I was today years old when I learned what a tax receivable agreement was. It's a cash bill the business agrees to carry. The short version here, the company gets a tax break, then pays about 85% of that break in cash back to Blackstone and the other people who sold you the stock. You as a shareholder only get to keep 15% of the benefit. It's real money leaving the company you own, going to the people who just cashed out for years after they're gone. And they don't even have to hold the stock to keep collecting. They could technically sell it. Number 3, this is what you would call a controlled company, so the governance guardrails are pretty optional. Blackstone will hold a majority of the combined voting power after the offering, which lets Jersey Mike's claim the controlled company exemption under New York Stock Exchange rules, where they're going to list. In plain terms, it does not need a majority independent board, and it can skip independent compensation and nominating committees. Number 4, there are no dividends coming to you, but the sponsor may take a nibble. The company has no current plan to pay dividends on the Class A stock that people will buy into, but the proceeds from this offering will go towards repaying the securitization debt and funding a distribution to the pre-IPO owners. And per the Financial Times, like we said, roughly $500 million was already dividend out through those securitizations before this S1 was public. Number 5, the profit number they want you to use leans on a big trust us. The $166 million in charitable donations that Jersey Mike's rightly puts on its own cover as a badge of honor, pretty cool, gets added back to make the profit line look bigger for the IPO. This giving was done under the previous founder. So the company adds back all this good stuff, And their logic is that this was a founder's discretionary generosity, which won't happen once Blackstone runs the place, which I guess is fair. It also means the founder era profits are almost useless in comparison, and you're trusting the company on what's truly one time, including that $52 million area director buyout that they'll keep paying for years. March is about to get a lot more profitable for Blackstone. Number 6, the debt is wicked cheap now, and it might not be later. So the $2.1 billion sits in a whole business securitization at blended rates between 2.5% and 5.6%, which is a lot better than my mortgage rate. But then you read the maturity structure. So the notes carry anticipated repayment dates starting in 2029 and legal final maturities out to 2052, my goodness, and beyond, which means the company is expected to refinance these tranches at whatever rates exist at the end of the decade. A brand collateralized bond issued in 2021 at 2.5% probably does not get refinanced at 2.5% if I was a betting man in 2029. This is not financial advice.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
Everyone in finance is adopting AI right now. There's a problem because there are a dozen disconnected tools. You got one for revenue, one for AP, one for close, and each one of these needs training and documentation. And the expertise to run them lives in your team's heads, not your systems. Maximor takes the opposite approach. One autonomous finance platform for the whole operation. Order to cash, procure to pay, the close, cash management, reporting, running on a single unified finance context that pulls from your ERP, billing, banks, even email and Slack. Maximor runs on self-learning agents that learn how your team already works. No prompts to write, no workflows to build, nothing to document. Every output is audit ready, and when a call needs human judgment, it escalates for review. Because the agents optimize, not just execute. And your KPIs improve. I'm talking about DSO, working capital, cash conversion. In fact, one PE-backed customer cut their close in half. Their audit findings from 7 to 0, back office costs down 70%. And in 6 months, no ERP rip and replace. You pay only for real outcomes, not seats. See it at maximor.ai. That is maximor.ai. The CFO role has evolved faster than the tools built to support it. Most finance teams are still running infrastructure designed for a job that no longer exists. The reporting, the reconciling, the close that bleeds into the next month or quarter. That's not finance, that's overhead with a really crappy title. And the cost isn't just your time, it's everything your best people aren't doing while they're buried in it. Agentic finance shouldn't multiply your output, it should eliminate the work that was never worth doing in the first place. And that's why I run mostly media on Brex, an intelligent finance platform with AI-powered agents that capture expenses automatically, enforce policy before the spend happens, and close your books in minutes instead of weeks. 35,000 companies like OpenAI, Coinbase, Anthropic, and DoorDash already run on Brex. It's time to get Brex AF. Learn more at brex.com/metrics. Today's episode is brought to you by Anrok, the sales tax platform behind companies like Anthropic, Notion, and Vanta. Here's a fun way to totally ruin a Tuesday. Open a letter from a state you've never set foot in, telling you that you owe back taxes you didn't know existed. Happened to me, because the rules never stop moving. States are now racing to tax AI, digital ads, streaming, really anything new, and they're doing it faster than a spreadsheet can keep up. Anrok handles all of it. One platform that watches your exposure everywhere, automates compliance, and flags risk before it turns into that nasty gram. That's why thousands of finance leaders trust Anrok to stay ahead. Talk to an Anrok sales tax expert for a personalized exposure estimate at anrok.com/RTN. That is ANROK.com/RTN. Valuation. Jersey Mike's hasn't set terms, but the reporting has the IPO landing between 10 and 12 billion. And Blackstone, remember, paid around 8 billion for the whole thing in early 2025 with a lot of debt. So restaurant franchises get valued on a multiple of EBITDA. Jersey Mike's did 339 million of adjusted EBITDA in 2025. If you stack the 12 billion equity target on the 1.9 billion of net debt, you're paying about 13.9 billion for the enterprise, which pencils out to 41x trailing EBITDA. On next year's estimate, it's around 35x. So here's where the comps sit today. Domino's, the best performing stock of the last 20 years, if you're comparing it to tech companies, 18x EBITDA. It's mature. It is the franchise gold standard and has the same securitized debt structure that Jersey Mike's uses. So that does make it a good comp. Wingstop, this is where the CEO came from. 23 to 25x EBITDA. It's the fastest grower of the last decade in Charlie Morrison's old shop. Worth noting that that number is down hard because Wingstop's US same-store sales went negative this year and the stock is off about 65% from its peak, but boy, is it delicious. Older franchise buyouts. Slower brands like Denny's, Del Taco, I've never heard of Del Taco, Bojangles, that's fun, 8 to 11x EBITDA. So they're asking 41x trailing for a business growing same-store sales in the low single digits against a peer set where the best growth story in the group trades at 25x while its comp shrinks. So how do you get there? Well, to underwrite $12 billion, you have to believe two things happen. Unit growth stays high, and the international bet in Canada and UK exceeds US level economics. Early call here, but Canada's first few stores are running above the domestic AUV, which is a start, but hey, it's a small base. So Blackstone's $8 billion from 18 months ago is probably the floor, right? My read is the business supports something closer to 9 to 10 billion on the current comps, and 12 billion is going to ask investors to pay up front for the international growth before it ever shows up in the numbers. So here's some miscellaneous stuff of note. It's pretty funny. They're scared of quantum computing coming for the turkey. The risk factors run the standard AI hedge where you just have to throw it in, I guess. Their tools could be incorrectly designed. It could leak their IP, could invite lawsuits. Then it keeps going and warns that their systems could someday be undone by quantum computing. This is a company that makes subs by hand to order in front of you. So somewhere in the drafting, a lawyer walked in the room and made them hedge against a quantum attack on the provolone. Hide the cheese. There's a hidden 53rd week of the calendar. I'm such a nerd for this. So Jersey Mike's runs a 52 or 53 week fiscal year, and every few years, a 14th week of a quarter will get bolted onto Q4. So most quarters have 13 weeks. The year it happens, the company picks up an extra week of sales the prior year didn't have, and the annual comp looks stronger for reasons that have nothing to do with more people buying subs. I love seasonality quirks because their fiscal year is no longer like just only ending on a December 31st. It ends on the final Sunday. No drive-thru is a feature, not a bug. A Jersey Mike's costs a lot less to build, that 500 grand or so, partly because they skip the drive-thru lane that Chick-fil-A or Wendy's pays for. This means that real estate is more available, it's cheaper build out, and a faster path to a franchisee's return. So what's the verdict here? It's a great business, and the subs are delicious. The royalty machine is legit, the operator's clear return worth re-upping, and the store-level margins are the kind you rarely see attached to actual food. The question isn't whether Jersey Mike's is good, it's whether $12 billion is the right price to buy it from Blackstone after Blackstone already piled the debt onto it, pulled its dividends, and kept the votes. So buy the sandwich every Friday, read the fine print twice before you buy the stock. None of this is investment advice. I wrote most of it on my kitchen table while my dog sat at my feet waiting for the scraps of the Italian sandwich that I got from Jersey Mike's today. Do your own homework. Wishing you the giant, extra vinegar, and an entry price that leaves something on the table for the rest of us. Peace. Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.